Hi, I'm Justin Kramer, President of Pyle Financial Services. Scott Pyle, Founder and Chief Investment Officer here at Pyle Financial Services. So here's what we want to talk about for just a few minutes, is taxes.
Yes.
Now, neither you or I are CPAs.
No.
However, we have found that the burden of wealth means you have to deal with taxes.
Yes.
So, if you're an investor, what might have happened to you last year with a negative return?
Well, what we've heard from many investors is while their portfolios were negative, they still paid taxes from 1099s. Mutual fund managers during the Kavanaugh hearings may have taken profits at the all-time highs, and then they ended up with losses, but they still received long-term and short-term capital gains.
So to be clear, last year, a number of investors had negative returns and paid capital gains on top of negative returns.
Yeah, we've seen people come in with that situation.
How did we help manage that potential liability for our clients?
Well, if you remember back in this time of pain as the market was correcting, while we still believed markets were going higher, that there was not a recession, we went through our client portfolios and looked at short-term losses, long-term losses, and we could take losses in one investment and then put it over in a similar investment, and we participated in this return, and we paid let's say it this way, we had a client I think had over 100,000 in gains that we were able to mitigate through short-term losses, and then they participated in the market. So we're very tax sensitive and tax efficient. We don't want to see portfolios, even in good years when the markets are up, we go in and look at short-term, long-term losses and gains and work the portfolio to mitigate taxes.
Well, that brings up a great point. So here we are, most of our client portfolios are up well north of 15%.
A lot.
And we're in the process now of taking those profits off the table.
Yes.
But they're all short-term gains.
Yes, if you bought them all here and went here, they're...
So if you're up 15, what do you keep it at? 9, 10, 11? Unless you're tax efficient.
That's right.
So how do we manage that?
Well, it goes back to your original discipline of investing. You know, we don't buy everything one day.
Yep.
We buy into markets, we look at value and price matters. So we have multiple positions of purchases in one stock investment or one mutual fund investment. And we can go in and selectively decide which ones we sell, which positions we sell, that have the least amount of tax obligations, so we can continue to be sensitive and efficient to taxes for our clients.
And you know, that's a great point. Here's a couple of questions that you ought to be asking yourself. When was the last time my wealth management team had a conversation with my tax and CPA team? Do they even know each other's names? Are they helping on an annual basis plan for tax burdens, or are they simply preparing you? Right? Do you get the call in March and tell you what you owe, or are you sitting down in January and February talking about how to mitigate those risks? If the answer to any of those is no, you really need to sit down with ourselves or another team that understands one of the single biggest threats to your wealth is tax management. Thanks for tuning in, and we look forward to seeing you next time.